it's Arjun. We hope all of you that tune in or read Superspike know that we are trying our hardest to be nonpartisan and present views from what we have called an equity research analyst mindset, which means it does not matter what we personally think about an issue. We're simply trying to do the work and get the call right. I think this week, though, we're going to have to confess that we are excited about the new energy team proposed by President-elect and former President Donald Trump via North Dakota Governor Doug Burgum for Secretary of the Interior and Liberty Energy CEO Chris Wright for Secretary of Energy. And President Trump has also proposed creating a new National Energy Council that will be headed by Governor Burgum that will look to coordinate a whole of government approach to America's energy policies. And we're going to apologize in advance that we are likely to sound far more partisan than we would prefer. And for those of you listening who have either served or currently serving in a Democratic administration, or that simply were not happy with the outcome of the recent elections, please know we do value you as a subscriber and especially appreciate the ongoing engagement, dialogue, and discussion with those of you that fall in that bucket. Now, the appointments of Governor Burgum and Mr. Wright, we'd say signify a return to an energy-first perspective over what had been sort of the climate crisis mentality, and one that, if we say energy first, what we mean, you're going to put abundance, reliability, geopolitical security, and affordability as the core drivers of an all-of-the-above approach to harnessing America's resources as well as its technology. And we would contrast that with the prior administration's emphasis on addressing climate change, which we see as a subsidiary issue to energy, which is primary. And energy, in our view, should be the centering point for how we think about policies going forward, versus that climate-only perspective, which often comes with, let's just call it, a climate activist type of agenda. The climate-only focus of recent years really took hold in the aftermath of COVID, and it really has been a motivating factor for not only the creation of Superspiked, which we've now been doing for almost 3 years, but also our eventual unretirement to Veriten. Now, Chris Wright in particular, the proposed energy secretary, has been quite outspoken via his Bettering Human Lives report, which I think everyone should read. You'll find it on the Liberty Energy website. We'll also include it in the show note. This report beautifully articulates why we use energy in the first place, which is to better human lives. Superspiked and Bettering Human Lives share a common spirit and worldview, and for that really drives our excitement for Chris's being named to this position. Now, in this week's video podcast, we will discuss reprioritizing energy abundance, reliability, security, and affordability, and how that differs from, let's just call it, the climate-only agenda of recent years, and what that means for energy equities. We had a written post last week that addressed, we'd encourage everyone to read, we'll again link to that in the show notes, that addresses various macro and policy issues around energy scenario analysis, power, new energies, and oil markets. Just as a reminder, if you're listening to this on Apple or Spotify podcasts, there's also an accompanying video that you can find on YouTube, Substack, or the Veriten website. And for those of you that only listen to or watch the videos or podcasts, please note that in just about every other week that we're not publishing a video, we also have a written post that you can find on Substack or the Veriten website. So let's start with a look at our country's proposed new energy leaders, and we wanted to make a few points. I think first and foremost, we are most excited that the U.S. is going to go back to centering issues around an energy-first perspective, prioritizing abundance, reliability, security, and affordability as the primary objectives. And we would contrast that with the sort of, quote, climate crisis agenda of recent years. We agree that environmental and climate objectives are important considerations, and we believe they're also fully aligned with an energy-first agenda that we expect from the new administration. Societal wealth, it is positively correlated with clean air, clean water, and resilience to adverse weather. And in our view, it's going to be, as we have been articulated in recent posts, those billion-person scale economies like China, like India, that ultimately drive de facto decarbonization due to their focus on geopolitical security, reliability, and affordability. And that, in our view, is what will drive the scaling of new energy sources and technologies. And we would differ that from a perspective that tries to mandate carbon reductions and takes that type of approach to driving new energies. It's an important distinction. And as we repeatedly say, everything we talk about, none of it is against or tries to disincentivize the development of new energy technologies. I think second, we would urge everyone to not fall for misleading, if not outright false media headlines that want to label everyone that doesn't sign up for the left of center climate crisis narrative and the corresponding agenda. Everyone who doesn't sign up for that is now labeled a climate denier. Absolutely false, and we push back hard on it. Read Bettering Human Lives. You can read Chris Wright in his own words. We both agree. He writes this. The Earth has warmed about 1.2, 1.3 degrees since the Industrial Revolution. The overwhelming evidence suggests it is due to burning fossil fuels, and there's an expectation for another degree of warming over the remainder of this century. Where Bettering Lives, Human Lives pushes back, where I push back, is the idea that we are currently in a climate catastrophe or that it's an urgent climate crisis. That is a different perspective. It is worthy of debate. And I deal with and interact with some of you who have sincerely held beliefs that people like myself are underestimating, I'm going to say, the non-linearity of continuing to put carbon in the atmosphere and what that could mean for future adverse weather events. I respect those differing viewpoints. And to me, that should be the point of the debate. But the idea that if you do not sign up for urgent climate catastrophe and all that goes with that agenda, that you are a climate denier, it really does the debate around energy and climate and the environment a real disservice. Now, it has been observed that the enthusiasm, especially for Chris Wright of Liberty Energy, to be Secretary of Energy, especially amongst those of us who are either executives or investors or on Wall Street, in and around, especially the traditional oil and gas sector, that there's an enthusiasm for Mr. Wright that might overstate what the actual Secretary of Energy does for the oil and gas sector, where a lot of the regulation or rules around leasing or what have you are in other parts of the government. And in fact, the DOE secretary is often more about science, technology, national labs, nuclear security, and so forth. This isn't sort of an energy minister's job as you would find in other countries. I'd say the excitement stems from Chris's outspoken views via his Bettering Human Lives philosophy and worldview. And it is bringing that perspective back to the energy discussion and debate that I think is the motivating factor for what has really been an outpouring of enthusiasm from especially those of us in and around traditional energy for Mr. Wright's nomination. I think the final point that excites people is really the creation of a National Energy Council to harness America's resources and technology for an all-of-the-above approach. All of the above. That includes a whole bunch of new stuff. It includes nuclear and so forth, not just oil and gas, all of the above, to American energy dominance. And I'm going to contrast that with the sort of climate czar approach, which centers carbon emissions as the centering point, and I think has led to some real policy mistakes or unfortunate, policy prescriptions that are out there. And I'm going to again recognize that these comments are going to sound far more partisan than I prefer. I apologize for that, and as always, we welcome at Super Spiked at Veriten all perspectives and viewpoints. We will now shift to the topic of bettering energy equities and the recentering of the discussion to energy from that climate-only perspective. We think it's going to be important to all the areas of energy. Traditional oil and gas for sure, but also power and also new energies. All three areas, oil and gas, power, new energies, we think benefit from getting back to the basics of prioritizing abundance, reliability, security, and affordability. And debates about the potential for peak oil and gas demand have contributed to reduced investor interest in the sector and a higher cost of capital. We've seen merchant power equities leading the world here. They have shown that when there's a recognition that desired demand is going to exceed easily available supply, investors can get excited about it. And we're reflecting back to a world where investors are going to go back to making that type of assessment. Not one that says, well, peak demand is going to happen because we have to abate carbon emissions by some arbitrarily short time frame, but one where we really get to what are the areas where demand is inflecting upward, what sources of energy, what technologies are inflecting positively, and is there readily available supply to meet that? And if not, where in the value chain do you want to invest? This to me is a very healthy reframing of how to think about energy and will drive investment in the sector to a much more meaningful degree than will that, I'm going to call it negative climate only framing of we have to limit the world and we have to kill emissions and that type of worldview that we've been mired in. And it's really just a very different perspective. And I think I want to highlight 4 areas. The most obvious one, the very clear winner that I think is now broadly recognized, is merchant power. That's probably more of a US comment when we look at, say, merchant power equities, but you need power generation in large parts of the developing world, large parts of the mature world or the rich world, and merchant power or generation is going to be a key area that the world is obviously recognizing. I think the second debate that is already starting to change is this idea that we need to force transition, especially from the big oils. And you heard this sort of, again, climate-only mindset, and you hear it from leaders of large organizations that have energy scenarios that will say big oil should be partnered on driving energy transition. Nonsense. Absolute nonsense. We've never agreed with that view. We didn't agree with it in 2021. We don't agree with it today in 2024. That's very different than saying, are there some logical adjacencies that they might want to pursue? I'm going to give 2 examples without commenting on whether this is good or bad. But ExxonMobil seems excited about some of the stuff they're doing in lithium and batteries. They view that as a logical adjacency for them. Occidental Petroleum, excited about their direct air capture business as an example. Investors can debate whether they like these investments or not, or whether those companies are going to be successful or not. That's not the point of this video. But the idea is companies exist for one reason. It is to profitably produce goods or services that consumers or businesses demand. That's it. It's not to affect societal change. It is to respond to it. If we see billion-person scale economies who do not have domestic crude oil thinking about how they're going to diversify their energy sources, and some large portion of that is going to be new energies, then you would want your big oils or medium or small oils contemplating those changes and seeing if there are areas to invest. But the idea that they should forcibly change because a bunch of global elites have decided we need to do this right now, that's the part that we push back hard on. I think the other big change, we're already seeing this, it's going to predate the new Trump administration coming in, is that ideological ESG that also arose during the COVID era, that for sure is fading. Now, we've long said and differentiated what we're going to call traditional environmental, social, and governance factors that not only don't bother us, but that we've always incorporated in our equity analysis. We've always cared about governance. Who owns the stock? Is there a government ownership stake? Is it a bunch of original founders? And how does that impact governance? We've always cared about diversity of thought amongst our boards and management teams. And we've thought it's critical for especially energy companies to care about worker safety, health, safety in the environment, and those kind of initiatives. And I would differentiate, I'm going to call that sort of traditional how are companies running themselves perspective to what in the recent years has become ideological ESG that is de facto climate advocacy. And that modern ESG, whatever you want to call it, it's already fading in relevance. And let's hope it will be killed in coming years. Every company has but one purpose: profitably produce goods and services that consumers and businesses want. Nothing more, nothing less. We are fortunately, I think, returning to those roots. Now, a major theme of the incoming Trump administration will be this notion of American energy dominance. And in terms of what it means for various sectors, I think it's really clear that there is a major need for new power generation and grid infrastructure, especially in the United States. We have an aging grid. We have a lot of intermittent resources that have come on the grid. We've retired a bunch of base load. There's now growing demand for the first time in many years, turbocharged by AI data centers or what have you. This is a major area of focus, and it is not, to the best of our awareness, featured on the campaign trail. We hear about drill, baby, drill, which is, I think, notionally people rightfully attribute as sort of an oil and gas-oriented perspective. The U.S. has drilled, baby drilled over the last decade. We've got records amounts of oil production in shale. I think it's a more open-ended question of what the Trump administration's approach will be to the power sector. And I'll just say that, here at Super Spiked and at Veriten, we are in favor in power of an all of the above approach. How do you motivate sufficient baseload generation capacity? Should that be natural gas? Should it be nuclear? Should it be something else? How do you motivate businesses to sort of pick what the rightful winners are? What is the role of regulation? These are all major questions that is often beyond our specific expertise as, frankly, traditional energy experts on the oil and gas side. But I think this is going to be a major question, a major focus going forward, and it is needed. I think for new energies, there is a question of which technologies are going to profitably scale and what is the role of an administration to help motivate these things. And I think if we were to take the topic of the, quote, Inflation Reduction Act, I do not like the name, but that is what it's called. If there was a goal to reshore technology development and some of these new businesses in the United States, that seems like a goal completely aligned with the incoming administration. I think if it's about picking specific technology winners or mandates, that's the part we would ideologically push back on. And how do you figure out the right way to get markets and innovation with some of what is the correct amount of regulation? I'm not sure what the right phrasing is there, but there is a need. We've said this last week, that America should be dominant, not just in oil and gas, but it's as important to be dominant in the new technologies and all that it encompasses. And that might be critical minerals processing and refining and mining, critical mining, refining and processing and critical minerals. It could be specific new technologies. It could be technology. And that is the kind of stuff that we would hope the new administration will recognize is as much in America's interest to dominate. And the reason is, there's no chance India 50 years from now is going to want to import 45 million barrels a day of oil. They're going to figure out other ways to power and fuel their economy. And they may not be able to figure out in the next decade. I've seen articles that India's maybe perhaps following the SUV craze that we have here in America. But the idea that they're going to be importing just massive amounts of it, they're going to try their hardest to avoid that, hopefully while still becoming rich. That is always the predominant goal. And that is where being dominant in new energies and wresting some of that control and dominance away from China, that should be fully aligned between the previous administration and the incoming administration. For oil, we are a dominant oil producer. We have been 90% plus of net oil supply growth over the last decade. We are well in excess of sort of the number 2 and number 3 producers. And it's been really perhaps the most notable change in perhaps my career and lifetime, America going from being very import dependent to being now on the margin a net exporter of oil. I think, how do we sustain this? Shale being the dominant driver, geologic realities will tell you that can't last forever. Even if we are optimists due to technology and engineering prowess, that we can continue to improve recovery rates and these kind of things, I think shale grinds higher for the foreseeable future. But how do we think about areas like Alaska, which is a critical future resource, offshore? What are the other areas within the United States that we should be thinking about to ensure over the long run, America remains a dominant oil producer? I think finally, we would hope an American energy dominance and an America first perspective might include a North America first weight to it as well. And that is Canada. Canada is a critical ally of ours. They've got substantial oil and natural gas resources. They've got their own local political challenges. We're not going to comment on the future of Prime Minister Trudeau and what should happen there. I cannot stand when non-Americans comment on Trump versus Biden or anyone else in the race. I'll try not to do the same. But perhaps in collaboration with either the current or future Canadian administration, as well as the leaders of the province of Alberta, how do we think about joint infrastructure expansion and ensuring Canada's very important and much needed resources, which can be amongst the, I'll use the term, ESG friendly resources in the world. They come from Canada. Good labor standards, good environmental standards. By the way, for those of you that particularly care, good climate standards. All of those drivers should make Canada part of the solution. We do hope that will be a feature of the incoming Trump administration. We've not heard as much, or at least I haven't, about where Trump stands on Canada. So let's talk about bettering cost of capital. And this is really for traditional energy equities, though could apply also to the new energy space. We've already seen it in merchant power. And it's really as the world shifts back to an energy first framing, we see the potential for cost of capital to improve. What that means in layman's terms is valuation improves. And the core driver is that very pessimistic, quote, climate crisis framing that says we're trying to limit emissions, and that's going to be the focus. And that's going to mean we're going to have peak oil and gas demand within some near-term time frame, either the next few years or the next decade or so. When investors are bombarded, again, I'm going to say falsely slow, with those types of messages, what they'll say is, you know what? Oil and gas prices are kind of volatile in the near term. They've just risen. I'm thinking like just after the Russia-Ukraine situation. Maybe oil prices are going to fade here. And if I think the business is going away in 5 or 10 years, why should I bother investing? That's been had a depressive effect on investment in the sector. And as we've said, especially to those of you who are more climate advocates, it's had a depressive effect on US, Canadian, and Western European oil and gas companies. It's not had a depressive effect on national oil companies in the rest of the world. How can that make sense? We'll be hopeful that sector cost of capital can improve. And I think the biggest thing is as the world starts to recognize, we've not believed that anyone can identify what year, certainly not even what decade, we're going to have peak oil or gas demand. As more of the world recognizes that that is true, again, massive unmet energy needs of the other 7 billion people on Earth. How are we meeting those? I think terminal value has a chance to come back into oil and gas valuations, and that means lower cost of capital, better valuations. I think at the company level, it really is about looking for inflections in growth and returns. And this is a sensitive point for investors. Profitability was very poor last decade. So when we talk about, quote, growth, we sometimes get critiqued for it. There's no question investors prefer companies that grow faster and that are profitable than those that stagnate or decline. If you do not have growth, it is reasonable to have some sort of liquidation strategy, either by massive dividend payouts or selling yourself. That's definitely better than wasting money. But the best performing companies, and you can see this in traditional oil and gas companies, you can see it in merchant power stocks, you can see it in technology stocks, NVIDIA, Microsoft, Apple. The market prefers profitable growth, and that is the challenge of any management team or board. M&A has been a big theme in the traditional oil and gas space in recent years. I'm going to say that much of it, not all of it, but a lot of it has been sort of defensive in orientation. How can we cut costs, optimize, these kind of things? And it's always a mixture of defense and offense. But I think this M&A trend continues. I think the question is, how do companies think about strategically adding risk opportunities when we are still in a world where cost of capital is generally depressed and the sector is still, all else equal, broadly out of favor? We'll show a graph in a second. It's got to be a better time to be adding assets. And I think even some of the recent transactions, I think you can see that as the world starts improving its outlook for future oil and gas demand and starts recognizing the business is not going away, you're starting to see well-conceived transactions. Not all transactions are good, but the ones that have a better chance of being good down the road, you're starting to see investors react perhaps a little more favorably, or at least not as negatively as perhaps they have in prior years. And that's an important, I think, change in tone coming. We're always looking for what are the areas that are next going to tighten, where desired demand is going to be greater than readily available supply. And we're also looking for areas that what is most overhyped and what is most underhyped today. And I will say, we are open-minded that with the beatdown that's come, broadly speaking, to the new energy space, there may be some things to look at in there. It's not necessarily our core area of background or expertise. There's some excellent Wall Street analysts. My former colleague, Brian Lee of Goldman Sachs, has always been a favorite. I enjoy James West at ISI. And now I'm going to get in trouble for only naming a couple names. But whether it's the pros, whether it's your own work, there can be areas that do make sense, including in the new energy space. So I'm just going to close this video with 3 quick pictures. This first one we've shown before. It is a graph of the energy sector's earnings weight in the S&P 500, which is the bluer line, versus its S&P sector weight, its market capitalization weight, which is the gray line. And a couple points here. Stocks move with earnings. And that is the point, that earnings growth will drive stocks higher. You can see there's a big gap now where the energy's S&P weight is well below its earnings weight. But you'll also notice in this most recent period, if you can see my cursor, that we've been in a negative earnings revision cycle really since, I want to say, the third quarter of 2002, kind of just at or after the peak of the Russia-Ukraine price impact. And when you're having negative earnings revisions, you cannot or should not expect a sector to buck that trend, really not until people believe that cycle is bottomed, stabilized, and is then on track to reverse. And I think if I combine that with the previous cost of capital comments, I would expect whenever this negative earnings revision cycle reverses, you can see a big catch-up trade in the sector. Now, this is not investment advice. These things can be hard to time. I leave that to the pros. We're just making the observation. You can see this a few different ways. The second graph that we're going to show here is a relative PE graph. It's of the PE of the energy stocks in the S&P 500 divided by the PE of the S&P 500. It makes a similar point of undervaluation in the 34-year history of relative PE. Energy stocks, while they were, I guess, a bit lower at the peak of Russia-Ukraine, you've now had commodity prices essentially normalize, yet you still see a sharply discounted valuation. And again, I do think when you get that EPS revision cycle to start turning positive again, there's a lot of catch-up potential to go with here. And I think we'll just end with a note of optimism. And this is a graph, we've shown this one before as well. It's the three publicly traded merchant power stocks versus NVIDIA, the hottest stock in the stock market, at least over the last few years. And these merchant power stocks have kept pace, in some cases been ahead of NVIDIA. I think it proves that the market is recognizing that while software is going to eat the world, all software requires hardware and all hardware requires power. And it is the optimism that when investors see that desired demand growth is in excess of readily available supply, you can get a pretty massive re-rating. So we'd like to end this video on a personal note and return to where this post started. Bettering human lives and Super Spiked share a common philosophy that everyone on Earth deserves to be energy rich. We also share a truth in energy worldview, which is the spiritual definition of Veriten. It's a play on Veritas, truth in energy. And I received a nice note last week from a prominent subscriber giving me credit for taking a stand in our last post and not being afraid to state my views. And this is a person whom I share some common ground with, but I'd say we do have different areas of emphasis and are a bit different in terms of some of the solutions we propose. And so I don't think this was just ideological within my bubble type of praise. I believe our new energy leaders have a strong passion for what they believe, but as business people, they're going to instinctively engage in absorbing a range of views and perspectives. In business, when the facts change, you do your best to change or evolve or hopefully be ahead of the curve, as the case may be. And that worldview is very different from, with all apologies, the activist entrenched mindset, which is that I'm going to fight to death and not give an inch and demand everyone accept what I think is best. And it's the difference, that is the difference between the existential climate crisis framing we've been in and a mindset that wants to better human lives. Thank you.